for anybody who doesn't know what the recent announcement was from the Bank of Canada, last week now, let everybody know what happened.
The Bank of Canada reduced the key rate by 25 basis points. It was the first cut since 2020, which is huge. And it's just signaling a lot of confidence, really in the real estate market for Canadians. The part of the reason that the Bank of Canada cut this key overnight rate is inflation certainly going in the right direction, which is awesome. And, leading up to the Bank of Canada announcement, the GDP was very soft. It didn't even meet the target. So, it was really pointing in the direction that we were going to have a cut. And many economists, and even some as much as like Scotiabank, they're predicting at least 3 more cuts this year, which will mean, in theory, if it's 25 basis points a cut, we're going to see the prime rate be 1% less at the end of the year than it was at the beginning of the year, which is great news for those of you that are in a variable rate mortgage, have a home equity line of credit, or have any debt that is tied to the prime rate. You're going to see your cost of borrowing be less. And if you have a variable mortgage that has an adjustable payment, you're going to see your payment be less as well. So great news. I think it's going to be a lot of confidence. But there could be some implications to a lower rate.
Okay. We like to educate, as we have alluded to earlier in the show, referenced. So the point of the Bank of Canada and why they lower or raise rates is tied in with inflation, basically,
It's
right?
basically inflation.
Yeah.
The Bank of Canada is a biased bank, and they're always biased to being more conservative than being more liberal.
Mm-hmm.
And what I'm saying by being more conservative is they would always err on the side of caution. So they are trying to drive inflation down. They let these rate increases kind of go too slow or didn't start early enough. And inflation was like a runaway train that left the station.
Yeah.
And they had to increase really over the last 18 months or so to drive inflation down. And inflation is going in the right direction. We want inflation to continue to lower and continue to stay low. And that's the one thing that the Bank of Canada is going to continue to watch. The thing that we need to remember is the changes that the Bank of Canada does, it doesn't take effect right away. So, some of the changes that they've done, it takes sometimes 3, 6, 9 months to take effect. So even with the rates being reduced, it's going to take several months to really become more stimulative to the economy or to the Canadian consumer. The one thing that we really need to watch out on is Canadians need to continue not spending. And they need to continue, keeping their consumer debt not increasing. And that's the one thing that the Bank of Canada will be really watching. They want to make sure that when these rates go down, Canadians don't suddenly go out and take on a lot more debt.
Yeah, I don't think that's going to happen with a 0.25 basis points.
I don't think so.
Yeah.
But again, this is a psychological change.
Yeah.
By 0.25 of a reduction, that's like 3%. 3% is not a lot of a percentage to maybe move the needle,
right.
But it's more perception, I think, to the consumer. And the rates are going to continue to soften. That's what they're projecting. The bank economists are coming out. Economists are kind of at large are saying that the rates are going to continue to reduce. And it's really changed the conversation that us as mortgage professionals are having with our customers. The shift has really been more and more variable, has been requested. Our advice has been more variable rate mortgages. If we were having this conversation 3 months ago, I can tell you, 3-year fixed was the most popular. I took part in a survey that Bell Media did with CTV, and they surveyed mortgage brokers across this country. And, the majority are still recommending a 3-year fix. And I think that advice probably has shifted as of last Wednesday. And I think we're going to continue seeing that shift, for the rest of the year. The reason that a lot of consumers decided to take the fixed rate, Todd, and why the 3-year was so popular is it was much lower than the variable. But there are implications to taking a fixed rate. Sometimes we think fixed is safer. Mm-hmm. Well, if you break your mortgage early, the fixed certainly can have a much larger penalty, especially if those rates go down. And you just don't have that flexibility. The nice thing with the variable is when the prime rate goes down, your cost of borrowing is going to go down. If you have an adjustable payment, your payment will go down. Or if you have a fixed payment, your amortization will get shorter. The other nice thing with the variable, if you need to break the mortgage early, it's only a penalty of 3 months interest. So that's really very flexible. Mm-hmm. And you can always convert your variable into a fixed rate. So that's why a lot more consumers are deciding to take the variable right now.
Yeah, for sure. And again, the debate over the variable, the fixed, and on it goes. You've been pretty consistently on the variable trend, right? This is something since I've known you, since we've been doing this show, And you stand by that, right?
Historically, consumers do better in a variable rate mortgage. Yes, the last 18 months, it has been more expensive, but like 18 months is a blip in the radar.
Right.
Even if we're looking at consumers that have had a variable for the last 5 years, still cheaper than the fixed.
And I would, sorry to interrupt, Clinton, but I would also think that you're better prepared instead of getting like people did at 1.9 or 1.5, and then this big rate shock. At 5
I am
years
more
out.
concerned with people coming out of these uber low fixed rates and even going into a fixed rate at double what they had.
That's right. As opposed to somebody with a variable.
They're good.
You're trucking along and you're used to what you're paying.
They're good.
Right. Yeah.
Let me tell you, my customers that are in a variable, some have converted. That's reality.
Mm-hmm.
It doesn't matter where the rate is. People will still convert because that's just like human nature.
Yeah.
About 60% of Canadians would take a 5-year fix. That is the most common rate up till maybe the last couple of years.
Yeah.
The conversation has shifted. Variable has always been less than fixed, but we've really turned the things upside down. The world's been turned upside down. And variable right now is more expensive still today than a fixed rate will be. But I can tell you by the end of this year, I suspect the variable will be lower.
All right, so what's the 5-year fixed right now being offered?
A good 5-year fix is sub 5%. So let's just even call it like 4.89.
And the variable right now is what?
A good variable somewhere around 6%.
Okay, 6. So what? So
we're talking like a 1% in a change.
So, but as the Bank of Canada interest rates go, it will likely go under that 5-year fixed within a couple of years.
A couple of years, maybe even a couple of months.
Maybe, okay, there you go.
I think maybe even by the end of the year, we're going to see the prime rate even be 75 basis points less. Right?
Yeah.
So then we're getting, a prime rate, in that, 6% range.
Yep.
We'll call it. And then if you have a mortgage that's prime minus 100, you're down in that 5%.
All right. So is there anything that we've been through this pandemic, but is there anything that could really rock the Bank of Canada to spike rates again? There
definitely is.
Yeah, like
and
what?
that's why I think consumers need to be educated. Yes, I think the Bank of Canada is going to continue to reduce. I think we're going to see rates 2% less than we do right now in basically a year and a half's time. By the end of next year, I think we're going to see the rates 2% less. Things that can impact that: inflation. Let's say inflation goes back up. Guess what? Bank of Canada is going to pump those brakes on the rate reductions. The other thing is if we see things like what happened with Ukraine, if we see something like a world event that's going to be outside of our control, that may impact inflation, and that might impact the decision that the Bank of Canada makes. Sorry, I have to say that. I'm really watching the U.S. The U.S. prior to the Bank of Canada announcement, they did a hold. Canada's usually not a first mover. Canada's not usually the ones that will go and decide, okay, we're going to increase, we're going to decrease. Even internationally, they're not. They kind of look and see what's going on with the rest of the world. Obviously, they're looking at what's going on at home, but they're really looking at more of a broad spectrum. After the Bank of Canada reduced the rates, the European situation, they've started to reduce as well. So it's going to be very, very interesting. There certainly has been some news in the bond market even this week. And a lot of consumers are asking me, now that the Bank of Canada reduced the key overnight rate, are fixed rates lower? They're not lower today, but there certainly has been some activity in the bond market, and the fixed rates are tied to what's going on in the bond market. So, those rates go down, we're going to start seeing lower fixed rates. Obviously, we're going to continue to watch what's going on in the bond market. Fixed rates aren't lower today, but we're going to continue watching. If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.